A public company announces it's buying Bitcoin. The stock price doubles overnight. Retail investors pile in, thinking they're getting Bitcoin exposure through the stock market. Here's what almost nobody explains before you buy. You're not buying Bitcoin. You're buying a wrapper around Bitcoin, priced by the market at whatever premium or discount it decides, and that premium can evaporate in weeks, taking half your money with it. Dozens of companies have copied this playbook since 2024. Most of them are now trading below the value of the Bitcoin they actually hold. This video breaks down exactly how Bitcoin Treasury companies work, why the premium that made early investors rich is the same mechanism now destroying late investors, the history that already proved this would happen, and how to tell the difference before you buy. A Bitcoin Treasury company is a publicly traded business that raises capital through stock sales, convertible debt, or preferred shares, and uses that capital to buy and hold Bitcoin on its balance sheet. The stock doesn't represent a normal operating business in the traditional sense anymore. It represents a claim on however much Bitcoin the company holds, plus whatever the market decides that claim is worth. This model was pioneered at scale by Strategy, formerly MicroStrategy, which converted from a software company into what is effectively a leveraged Bitcoin holding vehicle starting in 2020. Since then, dozens of companies across multiple countries have copied the model, often for assets other than Bitcoin. Ethereum, Solana, and other tokens now have their own version of the same structure. Net asset value, or NAV, is simple. It's the value of the Bitcoin the company holds, divided by the number of shares outstanding. If a company holds $1 billion in Bitcoin and has 100 million shares, the NAV per share is $10. Here's what most retail investors don't check. The stock rarely trades at exactly NAV. During bull markets and hype cycles, these stocks have traded at multiples of NAV, sometimes double, triple, or more. That premium reflects the market's belief that the company will keep raising capital and buying more Bitcoin per share over time. When that belief fades, during a market downturn, a slowdown in Bitcoin purchases, or simply loss of investor enthusiasm, the premium collapses toward NAV or below it. You can hold the stock while Bitcoin's price stays completely flat and still lose half your money, purely because the premium you paid for evaporated. This isn't a new phenomenon invented in 2024. Long before spot Bitcoin ETFs existed, the Grayscale Bitcoin Trust, ticker GBTC, was the main way for investors to get Bitcoin exposure through a regular brokerage account. For years, GBTC traded at a substantial premium to the Bitcoin it actually held, because it was one of the only regulated wrappers available and demand for that access exceeded supply. Then more competitors entered. Then market sentiment shifted. GBTC flipped from a persistent premium to a persistent discount, at one point trading at roughly half of what its underlying Bitcoin was actually worth, and it stayed there for years. Investors who bought GBTC during the premium years, believing they were buying Bitcoin, watched their Bitcoin exposure underperform actual Bitcoin by enormous margins, purely because of the wrapper's pricing mechanics. The current generation of Bitcoin Treasury companies is running the exact same experiment with a different legal structure. The people who lived through GBTC's collapse from premium to discount are the ones now watching this new wave with the most skepticism, not because they doubt Bitcoin, but because they've already seen this specific movie. Once Strategy demonstrated the model could send a stock price up dramatically, imitators followed fast. Public companies across sectors, many with no prior connection to crypto or even a real operating business, announced Bitcoin Treasury strategies, often with minimal actual capital committed at first. Some were small-cap shell companies whose stock price moved 10 times over, or more purely on a Treasury announcement, before they had bought any meaningful amount of Bitcoin at all. This isn't confined to Bitcoin. Ethereum Treasury companies, Solana Treasury companies, and other altcoin equivalents launched through 2025 and 2026, each pitching the same story: buy our stock, get leveraged exposure to the asset, benefit from our expertise in capital market strategy. The pattern is identical to ICO mania and SPAC mania before it. A legitimate mechanism, discovered by a first mover, then copied by dozens of operators chasing the same premium before the market repriced it. If this pattern sounds familiar, it should. Special Purpose Acquisition Companies, SPACs, went through an almost identical cycle a few years earlier. A handful of early SPAC sponsors demonstrated the model could generate outsized returns. Hundreds of copycat SPACs followed. Retail investors piled into SPAC shares based on sponsor reputation and hype alone, often before any target company was even named. The vast majority of those SPACs ended up trading well below their trust value, and many investors who bought after the initial hype lost significant money, while early sponsors and institutional investors who got in before the public listing walked away with structural profits regardless of outcome. Bitcoin Treasury companies are following the same life cycle: legitimate innovation, proof of concept from a credible first mover, an explosion of copycats with weaker fundamentals, and a later stage where the market sorts out which ones had a real business model and which ones were just riding a narrative. The bull case for paying above NAV isn't irrational on its face. A company like MicroStrategy can raise capital in ways an individual investor can't, issuing convertible bonds at low or zero interest, selling preferred stock to yield-seeking institutional buyers, using financial engineering to acquire Bitcoin per share faster than an individual buying spot Bitcoin could. If the company is genuinely growing its Bitcoin per share count over time, paying a premium for that growth engine can make mathematical sense. The problem is that most copycat companies cannot execute this playbook as effectively as the first mover. They have less access to cheap capital, less credibility with institutional lenders, and less ability to raise money on favorable terms once the market realizes there are dozens of nearly identical vehicles competing for the same pool of investor capital. Picture a treasury company trading at double its NAV. You buy in. The company's Bitcoin holdings go up 20% over the next year, a solid, realistic result. But the market's enthusiasm cools, and the premium compresses from double NAV down to a slight discount. Your Bitcoin exposure went up 20%. Your stock went down significantly because the multiple applied to that exposure collapsed by more than the underlying gain. This is precisely the pattern that has played out across a large share of Bitcoin and altcoin treasury vehicles. Multiple companies in this category have shifted from trading at premiums to trading at discounts to their NAV, meaning the market now values them at less than the crypto they hold in the bank. If you'd simply bought the underlying asset directly instead of the stock, you would have captured the full 20% gain with none of the premium compression loss. Most treasury companies use something called an at-the-market offering program, or ATM. This lets a company sell new shares directly into the open market gradually, at prevailing prices, rather than through a single traditional stock offering. When the stock trades at a premium to NAV, this is a powerful tool. The company sells shares at, say, double NAV, and uses all that cash to buy Bitcoin, which increases the Bitcoin held per remaining share, even after dilution. This is the mechanic that made the model work for early movers. But the same tool becomes dangerous in reverse. If a company is contractually or strategically committed to continuing its ATM program even after the premium shrinks or turns into a discount, it can end up selling shares below NAV just to raise operating cash, which mechanically destroys value for existing shareholders with every sale, the exact opposite of the accretive dynamic that attracted investors in the first place. Retail investors rarely track ATM filings closely enough to know which phase a company is currently in. Treasury companies fund additional Bitcoin purchases primarily by issuing new shares or convertible debt. Every time new shares are issued, existing shareholders own a smaller percentage of the company's total Bitcoin stack, unless the capital raised buys enough new Bitcoin per share to offset the dilution. This is the entire premise of the model. Prove that share issuance is accretive, meaning it increases Bitcoin per share despite dilution. When it works, existing holders benefit. When a company issues shares purely to survive, pay down debt, or fund operations unrelated to the treasury strategy, dilution occurs without an offsetting benefit. Shareholders lose ground with no corresponding gain in their Bitcoin exposure. Retail investors typically have no visibility into which type of issuance is happening until well after the fact, buried in quarterly filings most people never read. Many treasury companies fund Bitcoin purchases with convertible debt, not just equity. Debt introduces obligations a normal Bitcoin holder never faces. If Bitcoin's price falls significantly and stays down, and the company can't refinance or convert its debt into equity on favorable terms, it can be forced to sell Bitcoin at depressed prices to service or repay that debt, turning a paper loss into a realized one at the worst possible time, for the worst possible reason. This is structurally different from an individual holding Bitcoin in self-custody, who is never forced to sell regardless of price, because there's no lender, no maturity date, and no margin call attached to a cold wallet. Convertible bonds typically carry a conversion price. If the stock never rises back to that level before maturity, the company owes bondholders cash instead of stock, which can mean raising more debt, issuing more dilutive equity, or selling Treasury assets to cover the obligation. This model hasn't stayed confined to the US. Publicly listed companies in Japan, Hong Kong, the UK, and elsewhere have launched their own Bitcoin and crypto treasury strategies, each pitching local investors on the same. Get leveraged crypto exposure through a familiar stock market listing story. Regulatory environments differ significantly between these jurisdictions, which changes the risk profile in ways many retail investors don't research before buying. A treasury company operating under looser disclosure requirements in one market can be materially riskier than one filing detailed quarterly reports under stricter regimes elsewhere, even if both are pursuing an identical Bitcoin accumulation strategy on paper. Owning Bitcoin directly and owning shares in a company that owns Bitcoin are not the same asset for tax or legal purposes. Selling Bitcoin you hold directly triggers capital gains treatment based on your own holding period and cost basis. Selling shares in a treasury company triggers capital gains on the stock, which may have appreciated or depreciated completely independently of Bitcoin's actual price move because of the premium or discount mechanic already described. In a bankruptcy or insolvency scenario, a treasury company's Bitcoin holdings are also not directly yours. They belong to the company, and as a shareholder you have a residual claim behind creditors and bondholders, the same subordination that applies to any other public company's assets in a liquidation. Self-custodied Bitcoin has no equivalent counterparty risk, because there is no company standing between you and the asset. Early institutional investors and the company's own executives and advisors are frequently the ones who benefit most reliably. They often have access to shares, warrants, or convertible instruments priced well below where retail eventually buys on the open market. Investment banks structuring the convertible bond offerings collect substantial fees regardless of how the stock performs afterward. Retail investors buying on the announcement pump, after the premium has already been bid up by early movers, are structurally the last ones in, the same exit liquidity pattern seen in VC-backed token launches, just wrapped in a stock certificate instead of a token. Before buying any Bitcoin or crypto treasury stock, find the company's current Bitcoin or other asset holdings and share count, calculate NAV per share yourself, and compare it to the current stock price. Check whether the company funds purchases primarily through equity or through debt. And if debt, check the maturity dates and conversion terms. Check how experienced and credible the management team's capital markets track record actually is outside of the Treasury narrative. Check whether the company is actively running an ATM program and whether recent share sales happened above or below NAV. Ask whether the premium you're paying reflects a genuine, provable capital-raising advantage or simply hype following a copycat announcement. If you can't answer these questions, you don't know what you're actually buying. If your goal is Bitcoin exposure, buying Bitcoin directly, through spot purchase and self-custody or through a low-fee spot Bitcoin ETF, gives you that exposure without premium risk, dilution risk, or forced selling risk. Treasury company stocks can make sense for investors who specifically want leveraged, capital markets-driven exposure and who understand and accept the additional risks that come with it. They are not a simple proxy for buying Bitcoin, no matter how the announcement press release frames it. History already ran this experiment once with GBTC. The companies best positioned to survive a prolonged downturn are the ones with the least debt, the most credible management, and the smallest gap between stock price and NAV. Most copycats fail that test. Comment, "I checked the NAV if this changes how you'll look at these stocks," or didn't know this if the premium mechanic is new to you. Next video, I'm breaking down blockchain gaming, what actually survived the play-to-earn collapse, and whether any of it has genuine long-term value. Subscribe to Unbanked. The old money had a head start. You have the internet.